I ran 34 of Singapore's biggest dividend players through a 6 criteria scoring system and ranked them. In this video, I'm going to show you who the top 5 dividend stocks are, why they are scored so high, and what the risks are on each one. So let's not waste any time and let's jump right in. Starting with number 1, DBS. The first reason it tops the list is that it has a dividend growth that's hard to match anywhere on the SGX. Over the last 10 years, DBS has compounded its dividend as 17% a year versus OCBC at just 10.5% and UOB at 7.5%, making it the fastest dividend compounder of the 3 local banks by a wide margin. DBS is currently yielding around 5%, close to its 5-year high. For income investors, this is one of the more attractive entry windows in recent years. Not only that, the management has also confirmed that the 15 cents capital return per quarter will continue all the way to financial year 2027. This is an unusually high payout certainty for a sector where earnings can often be unpredictable. So what's actually backing this strong yield? Strong earnings. In financial year 2026, DBS hit a record return on equity of around 16%. That's well above its historical range of 10 to 12%. This strong performance was driven largely by wealth management, where its wealth management AUM grew 19% to $488 billion, while wealth management fee income was up by 29%. At 2.34 times book, DBS is at its highest valuation in years. However, this doesn't necessarily mean that DBS is expensive right now. That's because when ROE goes from 11% to 16%, the market pays more for the same book value. Plus, the earnings mix has also shifted too, since less of DBS income now comes from the balance sheet and more from the fees. Right now, most analysts are bullish on DBS. Their median target is $61.75, which is about 8.8% above where it is now. Bulls point to the record ROE, the lock-in dividend through financial year 2027, and wealth management that is still growing. Though, the risk is that if rates fall faster than expected, DBS net interest margin would compress, and the earnings growth story would stall. In short, this is what a Tier 1 dividend compounder looks like, and the track record speaks for itself. Quick pause, if you are looking for a broker to trade Singapore stocks, you can check out Longbridge. For new users, your first 90 days of trading on Longbridge are essentially free at $0 commission and 0% platform fees. And even after those 90 days are over, Longbridge continues to be one of the lowest cost brokers in the market. For SGX trades, the platform fee is only 0.03%, with the minimum starting from just 99 cents per order. Longbridge also supports odd lot trading on SGX. This means you do not need to buy a full bought lot just to get exposure to your favorite companies. This lets you accumulate your positions more gradually with dollar cost averaging at a more comfortable pace. New users can earn a 10% interest booster for 180 days on up to $2,000 placed in their Cash Plus money market fund. On top of that, if you meet their holding and trading requirements, you can earn rewards in the form of Nvidia shares worth up to $1,160. So if you are interested to sign up, you can check out the details via my exclusive link in the description below. Moving on to pick number 2, Parkway Life REIT. Parkway Life REIT owns Singapore's top 3 private hospitals plus 60 plus nursing homes across Japan. And because healthcare demand doesn't stop in a recession, that puts Parkway Life's income on some of the most stable ground in the REIT sector. And that is reflected in its DPU history. Since listing in 2007, Parkway Life's DPU has more than doubled, from 6.83 cents to 15.29 cents. Though along the way, there were 2 minor dips. But these dips were driven by yen weakness on its Japan portfolio, and not by any problem with the underlying business. One big reason the DPU holds up so consistently is its lease structure. Parkway Life's Singapore hospital leases run all the way to 2042, with an option to extend a further 10 years. And they are also CPI linked. This means that the rent goes up automatically with inflation. That's also why analysts are projecting close to 20% DPU growth for the financial year 2026. Based on that projection, Parkway Life's DPU would work out to roughly 18 cents per unit. If that plays out, that would mean that its yield would grow from 3.77% in financial year 2025 to around 4.44% on a forward basis. The analyst consensus is also positive. Overall, their median price target is at $4.79, which puts it at about 17.4% above where it is now. The bull case contractual rent step-up already locked in for financial year 2026, and CPI-linked lease escalators keep growing DPU through 2042 without needing acquisitions. The bad case? Japan. Any yen weakness would directly affect the DPU. Plus, if the Bank of Japan keeps hiking rates, the refinancing cost on Japan-denominated debt would go up too. To put it simply, this is a REIT that has grown its DPU for 18 years, has a 24% rent step-up already locked into the contract for this year, and analysts still see 17% upside from here. That's a combination that's hard to find anywhere else on SGX. Next up, ST Engineering. ST Engineering covers 3 businesses: aerospace, defense systems, and smart city infrastructure. What ties them together is that all 3 run on long-term government and institutional contracts. And that is exactly what makes the order book so strong. As of December 2025, ST Engineering had $33.2 billion in contracted backlog, with 3 to 4 years of revenue already locked in. And just recently, they also announced $4.8 billion in new contract wins. From 2017 to 2025, the dividend grew from 15 cents to 23 cents. That represents about 4% compounding every year. ST Engineering has also introduced a new dividend policy, where if its profits grow year on year, 1/3 of that increase gets paid out on top. That shows that management is confident in their future earnings growth. However, that said, its 1.68% dividend yield is rather low today. But if it continues to grow its earnings, 1/3 of that growth would feed directly into the dividend, so the yield on cost could keep climbing over time. On the analyst side, the company is broadly well-liked. Their median target is around $12.45, which puts it at about 16.2% above where it is now. The upside case is straightforward. ST Engineering has $33 billion locked order book, a new progressive dividend policy, and defense spending globally is still accelerating. However, the key risk is valuation. Right now, ST Engineering is at 72 times forward PE. While that doesn't mean that the stock will crash tomorrow, it does mean that there's very little room for error. So any contract delay or margin miss could cause the stock to derate fast. In short, the 1.68% yield won't work if you need income today. But for a long-term portfolio, you are essentially buying what the dividend could become in the future, and not what it is today. Next, Keppel DC REIT. Keppel DC REIT is SGX's largest pure-play data center REIT, and its growth is directly tied to AI infrastructure demand. It owns data centers across Singapore, Europe, and APAC, sitting in markets where hyperscaler demand is outpacing supply. And we can see that clearly in their earnings. In financial year 2025, their revenue was up 42.4% to $441.4 million. Net property income up 47.2%, and rental reversions came in at positive 45%. That signals genuine pricing power in the underlying markets. On the DPU side, it has grown from 6.84 cents in financial year 2015 to 10.38 cents in financial year 2025. That's a 10-year CAGR of about 4.2%. But what's notable is the recent acceleration. In financial year 2025 alone, its DPU was up by 9.8%. Right now, analyst sentiment on Keppel DC REIT remains bullish. Their median target is $2.60, which is about 10.2% above where it is now. The bull case is straightforward. Hyperscaler lease renewals have locked in higher rents. Singapore remains a scarce APAC data center hub, and DPU growth is still accelerating. However, the key thing to watch is that unlike Parkway Life, Keppel DC's DPU growth here isn't contractual. It depends on acquisitions and hyperscaler demand continuing. So if the AI narrative ever cools, the premium over NAV could compress even if DPU holds. That said, the AI tailwind here isn't theoretical. The earnings already show it. And if you believe the hyperscaler build-out could run for another few years, Keppel DC is probably your best proxy for that story on SGX. Last but not least, SGX, or Singapore Exchange. SGX is the only securities exchange in Singapore. This means every listing fee, trading fee, derivatives contract, and market data subscription flows through one place. That's a regulated monopoly that cannot be competed away. Starting financial year 2025, SGX published the exact quarterly dividend schedule all the way to financial year 2028, rising by 0.025 cents per quarter every quarter. While most companies will just say progressive dividend policy, SGX gave you the exact dollar amount. That's a different level of commitment altogether. At 1.92% yield, SGX has one of the lowest dividend yield among the 5 here. However, it's also the most predictable, where every quarterly increase through 2028 is already locked in. That said, most analysts are not bullish on SGX at this price. Their median target is $19.73, which is 8.3% below current levels. Where bulls see upside is in the underlying trading momentum. In the first half of financial year 2026, SGX net revenue grew 8%, equities cash was up 16%, FX hit a record daily average volume of $180 billion. That translated into a 12% jump in adjusted net profit. If that momentum continues, the bull case could start to look more credible. To summarize, SGX is the only stock on the list where you know the asset dividend 3 years out. Whether the entry price is right is a separate question. But the quality of the underlying business isn't going anywhere. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.